Good evening, ladies and gentlemen. This is Clueless 8, and this is a quick 15-minute broadcast, videocast on market forecasts for at 9:11 p.m. on September 13th, Sunday, 2015. I want to show a little bit of a wider perspective on what's going on. Keep in mind that when it comes to financial markets, trading, investing, there is a significant amount of noise that is emanated from the media, from human emotions that are played upon on the media, as well as from the print articles on different publications, from a significant amount of analysts voicing their opinions, you name it. Okay, news stories coming out from domestic and international fronts. It's just one cacophony of noise. Now, we live in a world where our lives are dominated by noise. What the other person says, what your fellow colleagues are thinking, what your spouses are thinking, your girlfriends, your boyfriends, your partners, whatever the case may be. And we're all influenced by that. That's human behavioral game theory. We have to, as traders, strive every single day, every single hour, every single minute to cut out the noise and look at pure robotic technicals that are in play. Now, technicals are not independent of emotions. Of course, there are emotions involved in it. However, given that 90 to 99% of daily trading is dominated by machines, algorithmic, high frequency trading programs, you have to think for a minute. Do they really have emotions? Or are they simply looking at patterns, price movements, arbitrage from on different, price codes, all kinds of stuff. So let me not get too deep into it and let me just show you the picture the way I'm seeing it. And I'm sure you guys will see the same. If you have the discipline, or I should say, work really hard to keep your mental devils and the little voices in your head on the side. Let's move. Here's a weekly chart of the S&P, of the E-minis, which are basically a proxy for the S&P 500. And what we're seeing here is this. All right. Here was your crash, which was a phenomenal buying opportunity, if you ask me. All right. Which almost tested the lows of October of 2014. I've covered that extensively in my video casts, which are a lot of them are freely available on the Clueless 8 YouTube channel. And for advanced coaching members who get to hear from me and talk to me directly in the coaching sessions, some of them are available too on the YouTube channel for a limited time. So here we are. This is a weekly chart. So what are we looking at? Right here, you can clearly see we are on a uptrend channel. What the weekly charts do is they try to mitigate and eliminate a significant of daily and hourly noise. So it's clear to see that, right? So when you look at this here and say you knew nothing about technical analysis, it's pretty clear that we want to go and test this 1991 or 1992.71 level. That translates into roughly 2,000 on the S&P 500, which translates roughly into 17,000 on the Dow Jones, which I've been talking about for the last week to 10 days. So saying all that, if you get up here, from what it looks like, it's very clear. If you get up here, you can make a significant amount of money based on my recommendations that I put across on having tactical buys on the long side, but the bias is on the long side over the short term. Now remember, this pattern can change rapidly on Wednesday when the Fed comes out with their decision of rate or no rate. So we'll see. But here we have a simple thing here. This is the Thinkorswim chart. You have a Darvas box I don't create these. These are created by the machines. Here's the Darvas box on the top, which is 2103. Forget that. We ain't getting there for a bit. And if we do get there, it's going to be fast and furious. And I can assure you, if you are not a flexible trader, you're going to miss out on those horrendous profits that need to be made. We're still making profits. So on a small, so that's the upper end of the Darvas, 2103, translates into about 2110 on the S&P 500, which in my opinion, as I've shown in the video cast, is a lower probability trade. On the lower end, we have the lower Darvas, the red line here, which is 1897 or so. Okay. So when you look at this on a visual basis, all right, and let me get my trusty drawing tool out here for everyone to see. You can clearly see that the distance, the risk reward, this is your reward, this is your risk. So forget all this mumbo jumbo, all the hardcore stuff that all of us talk about. Look at the risk reward. This is your reward based on the Darvas. Don't blame me. This is Mr. Darvas talking, right? So here is your reward. Here is your risk. Can you handle it? Because life and trading is all about risk reward. What are your probabilities of making money on the upside versus the downside? What's the probability that we completely break here and crash down to these lows? In my opinion, that's a low probability trade. Many multifaceted global macro factors, including the currency market, which is the fastest moving market in the world, the credit markets, the bond markets are saying that we are on a short term, which could last for anywhere from 48 to 72 hours, maybe a little bit longer. We're in a short-term uptrend. As traders and as tactical investors, we need to make money on the short-term trends. So this is definitely a possibility that we come by and test 1800 again. I'm sorry. Yeah, 1800 on the E-minis, but which is roughly about what, 1807 or 1800 something on the S&P 500. So, but that's a low probability event for the short term. In the meantime, we have this level that we need to conquer, and I think that's a very tradable trade. So let me clear this out again and make this very clear. Sometimes in life, just keep things simple. All right, just keep things simple. Nobody's saying we're going to get to the top of the trading band. This is the trading band, 2131 and right now 1800. Okay, that's a wide trading band. That's 300 S&P points. That's roughly 24 to 2500 Dow points. 99% of traders can't handle a 200 point move in the market up or down. Forget about 2,500 points. But please try to think a little bit more mechanically. My service is designed to talk the truth, the way I see it, the way I have profited, the way I have benefited, and the way I'm grateful for everything that I do in the financial markets. I'm not asking you to buy it at face value. All I'm saying is listen, act accordingly, use your own intuition, and move on. So this is what we're looking at here. Now keep in mind that technically speaking, you could be looking at this as an ascending triangle. Okay, this could be an ascending triangle right there. If we break up over the ascending triangle, the next logical move is a retest of this red line, which is a 50-week moving average, and this orange line, which is the 34-week moving average. Let me get something clear here, which I always look at technical analysis as something that you have to adapt to your own way of thinking. It might not be right, but at least if you're profiting from it, I have over the years, stick to it. I'm not here to reinvent the wheel. There are great technical analysts out there. Hats off to them. Are they making money during very difficult periods of the market? I doubt it, because they're all looking at the same old lines and the same old stuff, and I'm tired of it. It doesn't really matter. I'm doing fine. So the bottom line, I sound like Trump here, but anyway, and I'm certainly not Trump. So let's put it this way. A retest of the 50 and the 34 is very, very possible. It's also possible. I'm going to show you three different scenarios, and I'm going to leave. It's also possible that this pattern symmetry Okay, and pattern symmetries do occur because in nature, every action has an equal and opposite reaction. I have seen it so many times. I have acted upon it so many times, all the way back since 1996, 19, I would say since 1998. I can't even sit here and tell you the stories, okay? Have I been always been there from the bottom to the way up? Absolutely not. Over the last couple of years, I've been very consistent because I've managed to manage the little demons in my head and listen to what the market is trying to tell me, not in the voices you hear from CNBC or Bloomberg, but in the technical aspects of what's going on. That's what I'm sharing with you guys. So take it or leave it. Doesn't make money for me. So here we are. This pattern at some point will get completed. Okay? So that's it. Now, let's look at something here. We have had a tremendous pullback. We're talking about multi-year bear markets. We're talking about global depression. We're talking about you name it. And I'm not talking about the Syrian refugees either who are using their cell phones to call back home. Who's paying the bills? Oh, I don't want to go there. All right. Anyway, the bottom line is this here. Through all this massacre, watch these two lines. Let me just zoom in a little bit more. These two highways. Remember, this was the move away. Just imagine the market moving along a highway. It kind of just stays there, moves around, but stays on the highway. 34-week moving average, 50-week moving average. Same thing on the daily. But look at it. I'm showing you the widest picture here, okay? Weeks in a row. So look what happened. Nothing happened. The highway still seems to be going on. It's almost like a Google self-driving car, just keeps on going. The highway keeps on going. Have we deviated from the highway due to the global shocks that took place? The currency devaluation in China, Chinese slowdown, Fed rate hike tantrums, you name it, slowing corporate profits. Yes. So, but what's happening on a weekly basis? This little highway that we're talking about, the 34 and the 50, continues to go sideways to flat, just the way it did here through all these machinations of the market and the volatility. This is all volatility, right? This is all volatility. So what I'm trying to get at, that if there is real traumatic damage to the market, like a wound where the patient's going to die, i.e. the market is going to fall into a complete bear market. Well, at least these highways, which is the 34 and the 50-day moving average, and the prices are not showing that. The key word is yet. We don't know that till we'll find that out months down the road. The way you can tell we're going into a bear market, I don't care whether you listen to Goldman Sachs analysts, and believe me, I work with some of the best firms in the street, okay, is you have to look at these moving averages turning down. So let me get that trusty drawing tool out. When you start to see these moving averages turning down on the weekly, okay, sharp curve down or whatever, you know we're in trouble. In the meantime, I'm not saying everything's great. All I'm simply saying is that we haven't seen any real technical damage on the highways yet. So what happens when you deviate away from the highway? You try to get back to it. It's called mean reversion. Okay. So if there is mean reversion, we're going to get up here at one point. But in the meantime, we have some short-term levels that we need to traverse in order to get there. Okay. So very important thing to keep in mind. Things I've learned, things I'm sharing. That's all for tonight. Listen to the very critical advanced coaching session that I conducted this morning. Covers a lot of behavioral dynamics and the whole works. And thank you for supporting the service. Get your friends to join, make a lot of money, and think out of the box, for God's sakes, because that's the only way to do it. Welcome to Clueless Day Trading.